After a big 3-day rally in stocks, it's fair to ask, who's on the ropes now? The bulls or the bears? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. As clients and regular viewers know, the CCM market model has two major components. The first component helps us with the prudent allocation between growth-oriented assets and conservative assets. And the second part of the model is the ETF scoring system that helps us identify what to plug in to the two sides of the portfolio. We're going to look at some of the charts followed by the ETF scoring system. The purpose of the exercise is the weight of the evidence. If we can gain an understanding of what the bigger picture looks like, where the weak trends are and where the bullish trends are, it gives us a much better indication and feel for what's going on in the global economy. Since there's no magic time frame, magic moving average, magic indicator, or magic risk-on, risk-off ratio, the CCM market model is highly diversified, and that would include diversification between time frames and moving averages. If we understand what a low probability period looks like and a high probability period, which would be the extremes, it's easier for us to understand everything else that falls in between. We're looking at emerging markets weekly here. Regular viewers know that a full bore bearish look is when price is below both moving averages, blue is below red, and the slopes of both are down, telling us that in July of 2008, the probability of bad things happening was higher than the probability of good things happening, and indeed very bad things did happen in that case. On the other side of the coin, when things started to improve, we got a bullish moving average crossover here in April of 2009, telling us that the probability of good things happening was now higher. How does the exact same chart look today? Despite the 3% rally that was taking place this week as of approximately 1 o'clock on February 19th, the chart still has a full bore bearish look. The last thing that it did was make a lower low on the weekly chart. And you can see that we do get counter trend moves during bearish trends, and we also get counter trend moves during bullish trends. Is there anything encouraging on this chart? The answer is yes. It's possible that we're making a higher low here. If we go on to make a higher high, that would improve the odds of seeing at least something like a sharp counter trend rally. Transitioning back to the land of baseball, hot dogs, apple pie, and Chevrolet, NASDAQ weekly. These are the longer-term moving averages. There's no free lunch in the markets. The benefit of using longer duration weekly moving averages is fewer whipsaws. The negative is the signals come later, and that's why it helps to diversify so you get a little bit of both. The NASDAQ, you can see we get a bearish cross here in 2008 and never get a bullish cross during the whole financial crisis bear market. You can see we get a bearish cross here early in calendar year 2008. Blue never retakes red during the entire financial crisis bear market, telling us that the probability of this being a counter trend rally remained relatively high. When sentiment started to turn, since these are longer duration moving averages, the market bottoms in March. But if somebody told you to invest in May of 2009, looking back now, that was probably a pretty good signal, and the bullish trend continued after the signal came. This is the EFA ETF weekly, or a basket of foreign stocks. Low probability look here in 2008, higher probability look here. The present day still has a full bore bearish look on Friday, February 19th, and we also have been making a series of lower lows and lower highs. This high is lower than this high. This low is lower than this low. and this low here is lower than this low. The last thing this weekly chart did was print a lower low. S&P 500 weekly, notice during the sharp counter trend rally here, we never get the bullish moving average crossover. It turns out to be helpful because bad things happened after this period here. 2009, the same moving averages had a bullish moving average crossover, giving us the full bore bearish look in the first half of calendar year 2009. Near last week's lows, the S&P 500 was down something on the order of 10.5%. Year to date, maybe worse at the intraday low. And as you might imagine, a 3-day bounce, no matter how sharp the bounce, really has not made a dent in the existing downtrends. This weekly chart here is as of the close on Friday, February 19th. We have price below both moving averages, blue below red, and the slopes of both are down. Same concepts. This is the Vanguard VTI, or total stock market ETF. How does the same chart look in 2016? Everything that we said about the weekly EFA chart applies to VTI as well. Retail, the lifeblood of the U.S. consumer-driven economy. We get the full bore bearish look here in 2007 and the full bore bullish look relatively early in the bull market in calendar year 2009. Based on the evidence that we have in hand, the big pop this week still looks like a counter trend rally, but on this chart we do have a new weekly closing high relative to this high here. Unfortunately, it follows a new weekly closing low here, but all things being equal, this is some improvement on the chart of XRT. But right now, it has occurred within the context of a clearly defined downtrend. These are our longer duration weekly moving averages that we frequently cover in this CCM weekly video. The concepts are exactly the same. If our chart looks like this, there's numerous things that we would like to see during a rally in terms of observable improvement. We prefer blue to move from the bottom to the top of the moving averages here. Notice the slopes of all of the moving averages are down, and here the slopes of all of them are up. Here price is below all of them. Here eventually it recaptures all of them, telling us that the probability of good things happening is much, much better here than it was here in late calendar year 2007. So do we have any of that observable improvement today? This SPY weekly is as of roughly 3 p.m. on Friday. It was up 2.71% for the week, but as you can see, mathematically, it really didn't change much. This still looks like this and really doesn't look anything like this. We can see some of these slopes starting to improve a little bit, but they're still all down. Prices below all of them, and blue remains on the bottom. As always, we're open to improvement, but we'd like to see it rather than anticipate it under our system. Staying with the global equity weight of the evidence theme, Germany also had bearish moving average crossovers that were helpful in calendar year 2008 and a bullish moving average crossover on the weekly chart in the first half of calendar year 2009. Like many equity-based ETFs, EWG saw a nice bounce this week. 1 o'clock on Friday, up 3.37% for the week. But you can see we still have a full-bore bearish look. How about defensive assets? How are they doing? Utilities, full-bore bullish look on Friday. Utilities XLU late in the week, 330, was up 1.32% for the week. IEF right around 330 on Friday was basically flat for the week. And FXY, the Japanese yen, was up 0.60 for the week. Full bore bullish look, full bore bullish on the weekly charts. You would think, and typically What you see at a sustainable low is the S&P 500 goes up by 2 to 4% in a week. And these assets, especially bonds, tend to get hammered. We did not see people run from defensive bonds this week. That may begin at any time, but we haven't seen it yet, and there's no material change on these defensive ETF charts. It's a daily chart of the S&P 500 as of the close on Wednesday, February 17th. This is a week ago today. This is Friday's big rally. Holiday shortened week. First day of the week was Tuesday. This is Wednesday. Before the market opened on Thursday, the tweet said, given the strength of the candles the last 3 days, 1, 2, 3, even if resistance below 1950-ish holds, here's 1950, this is the resistance, we may need an indecisive candle day first. So let's fast forward here as we approached possible resistance and look at what happened on Thursday and Friday. And let's take a look at those candles. And did we get an indecisive look relative to these strong buying conviction candles here? Same chart 2 days later as of the close on Friday, February 19th. We did indeed get some candles here and here that have somewhat of an indecisive look. You can see this is indecisive here. Here's somewhat of an indecisive look, and we get a reversal, an indecisive look here, numerous indecisive candles here before a reversal. What do these two candles tell us? They tell us that the market appears to be respecting these support lines that we tweeted out before the week started. It doesn't tell us if we're going to clear 1950 next week. That's to be determined. And if we do clear 1950, as we've shown in this video or will show, the long-term trends are so weak that a move into this area here probably would not change the math significantly. However, the higher that we get above 1940 to 1950, the math would start to improve, and if we can get to this side, it improves the probability of potentially testing one of these higher trend lines here or some of the Fibonacci levels that we'll cover elsewhere in this video. Just updating our ACWI Global Stocks ETF weekly. From a bullish perspective, in terms of bullish probabilities, we would prefer to see this ETF recapture this blue line. We were up over 3% late on Friday, but we still remain below the blue line. Very similar concepts here on the weekly small cap chart. A breakout here that occurred in calendar year 2013, retested it and passed, broke down here and retested that, and it held. This blue line here might act as resistance if we continue to rally. A few takeaways here. Friday daily NYSE chart. Notice how the market has been unable to print any type of important higher high since about mid-year 2015. We do have one here and then a rally here, but it was unable to break the downward sloping trend line. Even recently, this is a lower low relative to this low, and the rally that we're having right now so far has been unable to exceed this high. We have not recaptured the low from October of 2014, August of 2015, or September of 2015. This weekly chart of the NYSE as of 1:18 p.m. on Friday pretty much speaks for itself. There's no real improvement here. Lower low, and we have yet to make a higher high even above the last high, and we have not retaken this line here. If we do any of those things, it starts to improve, especially the intermediate term bullish odds. This is one of the crude oil charts that we covered a few weeks ago. These are the lines that we drew a few weeks ago. You can see that even on the rallies, we haven't even cleared this first downward sloping trend line here. That's something that we might do, but we haven't done it yet. And we also have white space below on all of these parallel trend channels. QQQ chart daily, 2:25 p.m. Friday. I just checked that it actually closed lower than this, so everything that I'm saying would apply to the closing chart as well. You can see similar theme here. A lower low. When we rally back so far, we've made a lower high, and it seems as if the rally has stopped at a logical level if this resistance holds, and everything relative to resistance is an if, and it's possible resistance. It's possible that we could move back down towards the lower end of this trend channel. The good news is we did recapture all of these levels here. So if QQQ can make a higher high here and break above this line, good things could happen, and we'll keep an open mind about that. Right now, this chart really hasn't done anything that's really overly impressive. Equal weight S&P 500 ETF RSP daily. What once was support may now act as resistance, So far, it has acted as resistance, and we'll keep an open mind about what happens next week. Just a quick reminder about counter trend rallies. This is 2007, this is 2008, S&P 500, 200-day, 50-day. You can see we have countless bullish and strong-looking candles within the context of a primary downtrend. These are normal counter trend rallies. It should also be noted, every chart that we're showing in this video, we acknowledge that we can get strong counter trend rallies, and we absolutely, positively may get one in calendar year 2016, and it may have already started. But the charts that we're showing this week really haven't done anything overly impressive yet. We would become more impressed if the S&P 500 could clear 1940, and more importantly, around 1965-ish. Now we're looking at the same 200-day in red and 50-day in blue. We've just removed stressful price from the equation. This is the look of the moving averages a week ago on February 12th. Did the big rally this week change the trends? Now we're looking at the same chart a week later on the 19th, Friday. No real change here. Keep in mind it's not unusual for downtrends at some point to rally back and maybe tag the 50-day moving average. That's one possible scenario. Another possible scenario is a bottom and a strong rally. As a reference point, the 50-day on the 19th is at 1954. In the 200-day, the downward sloping and bearish 200-day is near 2030. Let's assume the S&P 500 clears the cluster of resistance here. Some other things to be aware of. We've got our A to B fib and another A to B fib here. If we retraced these declines, our fibs fall between 1936 and 2015 on the S&P 500. This is one set of fibs here in orange. The other set of the major fibs is in blue. So even if we get into what appears to be an easy space, the S&P may have to contend with normal retracements of an existing downtrend, which may act as possible resistance. Friday the 19th at 2:29 p.m. This is our monthly SPY chart. S&P 500 daily, we're still in this to be determined area, and the market will figure out if it wants to rally in this direction or drop again. You can see clearly here, support, what once was support may now act as resistance. We move back to the exact same line this week and then fell. So if you're a bull, a good step is to get to this side of the blue line. If you're a bear, you'd prefer to get to this side of this line here, and thus the to be determined. Over the last 4 sessions in the shortened week, XLE was unable to capture these levels here. It closed Friday at 56.81. As you can see here, this daily chart of GLD or gold, GLD's been in a longer term downtrend, resistance, 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 parallel lines, resistance. We were able to hold at the bottom here, logical level, clear this level here and hold it with a gap, another gap here, and clear this level here. This, like every single chart presented in this video, just speaks to probabilities. The probability of good things happening in gold is higher today than it was here, 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 or here. We'll keep an open mind about what happens with GLD, and we'll also respect that it still has a lot to prove due to this established downtrend. Remember, we showed earlier in the video that IEF, or intermediate term treasury bonds, still had a full bore bullish look on a weekly chart. The same thing can be said for TLT, a defensive asset. Here's another breakout. All things being equal, we would prefer to buy things that are in established uptrends. Here, this ratio is in an established downtrend, but it too has cleared some levels that have held dating all the way back to 2014. This isn't negative for TLT. It just tells you that gold is now doing some things that it was unable to do over the last 24 months or so. This weekly chart does a good job of summarizing the big picture here. Last thing it did was make a lower low on a weekly basis. The current impressive rally has yet to even clear this high here, which it may. So far, it's rallied back to this logical level here, and we'll learn something either way. If we move in this direction here, we'll learn something about short and intermediate term bullish probabilities, and if we bounce back in this direction here, given the weak profiles that we still have, it's possible that we could fall at a rapid rate. But this is, especially in the short run, to be determined. And we have to keep in mind that even in the context of an established downtrend and a downward sloping 200-day and a downward sloping 50-day, you can get a counter trend rally that lasts literally months. This rally here lasts roughly 2 months, and then we resume the existing primary trend. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.